All right, so what we're looking at here, of course, is the basic 14-day free trial to power options. For those of you who are just getting started, let me change this real quick. I don't like the way that looks. I apologize, folks. Nope, that didn't do it either. Okay, I apologize. Never mind. All right. So those of you who are just getting started, I do encourage you to take advantage of the 4 steps here. The quick start guide, flash tutorials, you can access the various webinars, and of course, trial members and subscribers can schedule a coaching session at any time. That's essentially a 35 to 45-minute phone conversation with myself, Ernie, or one of the other staff members. Walk you through the tools on the site and answer any questions that you have. Now, I'm going to navigate over to the portfolio. We had a question come in from Michael, I believe, and this was in regards to a position on LULU, on Lulu. And it was a calendar spread, and based on the question that was emailed in, I'm assuming that it was a horizontal spread, meaning same strike. The email said that he had the short August 31st, 129 expiring today. Of course, it's deep in the money. He's also holding the September 7th, next week out, 129 strike. This is a calendar spread because the options have different expirations. However, it's referred to as a horizontal or same strike spread. I apologize for that. There we go. Let's get that in the right view. All right, there we go. So unfortunately, with the horizontal spreads, you usually end up getting a very low debit to enter these positions with the same strike. Even if you're 1, 2, or even 3 weeks apart, it's still a low debit. You may have the potential for a reasonable profit against the debit, but if the stock moves swiftly, one direction or the other, you have a much tighter upper and lower break even. Now that's sort of the situation I believe we found ourselves in with this particular horizontal spread. Calendar spread, but it's called a horizontal, same strike. Now, what is interesting about the outcome of this potential situation? Well, today at expiration, one of a few things could happen. The stock is trading at about 155. You're short a 129 call that expires today, but you're also long a 129 call for next week. So aside from the fact that the position has gone against you, what can we expect to happen today if we didn't close or adjust the position? Well, number one, your broker, I should say, are going to be assigned on the short 129 call. Now, that means one of two things will happen. Your broker may exercise the long to deliver the short, meaning it'll simply buy shares of stock at 129, sell them at 129, and we're out the net debit of the position. Okay? So to cover any of their bases, to cover the obligation of the short call that's deep in the money at this time, they may just exercise the long to deliver the short. Not every broker will do that. Okay? It also depends on what account you have and what you're able to do as far as trading requirements and trading level. What do I mean by that? If I'm in a restricted IRA account, I may not be able to short shares of stock, or may not be able to be short shares of stock. If my broker just assigns, if I just get assigned to this 129 and the broker doesn't exercise the long, I'm now short shares of Lulu. In this case, 20 contracts would be 2,000. I'm short 2,000 shares of Lulu at 129, but I have a 129 call. It's essentially a married call position, but I'm already at the maximum loss because the stock's trading at 154. Could it pull back next week? Likely, but not down to 129 where I could potentially realize a profit. So you'd now be short stock and still holding the long call. But if I'm in a restricted account where I can't be short stock, well, they might not have let me trade the diagonal or horizontal spread anyway in that case. But if that happened and I couldn't be short shares of stock, they would exercise it. But if I could be short shares of stock, come Monday, I'm short 2,000 shares at 129. I'm holding a 129 call. I'm in a married call that's essentially at its maximum loss. Okay. Now, the third thing that could happen there, of course, is that if the stock keeps going up at this point, it's kind of okay. I've already locked in the maximum loss at 37.40 because I do still have the right next Friday to buy the shares at 129. And a gain in the stock that's going to cause my short position to lose, my short stock position to lose, is also going to be covered on Friday intrinsically by the long. Now, the other side of that, what could possibly go wrong is that if you end up being short shares of stock as in number 2, but for whatever reason your broker does not exercise the long, but looks at it as 2 different positions and says, well, that's a lot of money for you to be short. They give you a margin call if the stock moves up a little bit more. Probably unlikely. They would exercise that long to deliver the short shares of stock. But in the weird case that they gave you a margin call and forced you to buy shares of Lulu at 156, well, now you're at full loss. So what I do is just sell to close the 129 call to cover that loss, but I'm still at this max loss of about 37.40. Worst case scenario, you end up being short the stock, you get a margin call on Tuesday or Wednesday, you buy the shares at 156 to cover the short, and then the stock collapses in the next 2 days and is below 129 at Friday expiration, and your 129 call expires worthless. A lot of weird things would have to come into play for that to happen. But remember, it is a possibility. Okay? Highly unlikely. So this is just an example. Anytime you're in any type of spread, even if this was a bull call debit spread with the same expiration but different strikes, remember, you still might have an obligation here. You can be assigned at any time. If this was a bull call debit spread at the 130, 129 strike for September 7th or September 14th, I could be assigned at any time. In theory, my broker should exercise the long to cover the short, but if you remember 6 to 8 months ago, we had a scenario where it did not happen for the customer. He was in a diagonal spread, was assigned early on the short on ex-dividend day. They didn't exercise the long to get him out of the position because they said it was different expiration cycles, so it didn't match up as truly a debit spread would, a vertical spread I should say. And then he ended up having to pay the dividend because he was short shares of stock on the ex-dividend date. So that was sort of a double whammy. But it is something that even if you're in a spread, a bull call debit that's in the money, a calendar call spread, either horizontal or diagonal, where the short option is slightly in the money, maybe even slightly out of the money, you should always know when that ex-dividend date is if the stock pays a dividend, because you may be assigned early on that short. Your broker may or may not exercise the long. It's just something to consider. But in general, horizontal spreads, a lot like butterflies. So this is a position I entered using kind of fake numbers here to show what the max risk would be. But if we opened one today on Lulu, let's take a diagonal or a horizontal spread, same strike spread, using September 7th. This is not a recommendation or suggestion, of course, seeing how this one turned out. But let's sell the 155 call and go out to September 21, only 2 weeks further out in time, and buy a 155 call. This will be our diagonal spread. Done at the current time with the current prices, this gives us a net debit of 173.50. And if the stock is trading right at 155 on Friday, September 7th, well, the long call value would still give us a profit, theoretical, based on the Black-Scholes of 175. So it's almost 100% potential return. But this is only about a 5-point upper or lower break even. I mean, if the stock goes above 159.62 or so, you start to lose money on the upside. You probably want to buy to close the short call and maybe roll it up to a higher strike or move it further on. If it drops below 150.84, now at a loss at a downside, we'd have to consider maybe adjusting the spread, maybe buying a put if our sentiment is completely changed in order to stay in profitability. But just like an iron butterfly or an all call or an all put butterfly, horizontal spreads give you the potential for a very high percentage return. Low cost basis, which is attractive, it is a very neutral position and you have a very tight range of upper to lower break even. So you could say, how could you go wrong if I've got 100% profit? Well, in theory, you've only got maybe a 42, 43% chance of making, actually it's probably only about a 4% chance of making exactly that maximum return. There is probably a 40% chance, probability I should say, that you'd make at least 50% or so of that maximum return in this range. And there's probably a 70% chance that you'll make some profitability. And there's probably a 40% chance that you'll lose. There's probably a 5% chance that you take a large loss on a wild swing. Just depends on what the market does and if any bad news comes out. Again, the trick here is that although these look attractive, more often than not, when you enter these kind of spreads, even on broad-based indexes, ETFs, these type of very pinpoint, perfect profit and loss charts, most of the time you're going to end up in this range. Decent gain, little bit of gain, little bit of loss. This would probably represent 80% of your trades. I mean that without management. If the stock starts to move one direction or the other, you'd probably manage your butterfly. You'd probably manage the horizontal spread, call or put in this case. Very rarely, probably only 5 to 10% of the time, are you going to be at that peak or close to it, within 5% of the peak profit. Sometimes you'll be in here. Most of the time you're going to be in this range, and then sometimes you'll be down here. So when you see that profit and loss chart, you see 100% return on a iron butterfly, all call, all put butterfly, horizontal calendar call spread here, horizontal calendar put. Just remember, you're not going to be hitting this maximum profit most of the time. Right? It is a very neutral strategy. You don't want essentially the stock to move at all, or the ETF or the index also. All right, Sam, of course, points out the reason this happened is that Lulu was a blowout of earnings, and the fast money that said to buy before the earnings, that was the first time they were correct in a long time. Yeah, but Sam has a good point. A moment ago, I had mentioned that with this type of strategy, if I'm in a short call of any kind, in a diagonal spread, in a calendar call spread, even in a butterfly, all call butterfly or an iron butterfly, when the stock's right around that short call strike price, I have to be wary of the ex-dividend date, because if it's coming up, I may be assigned early. But this is never a strategy I would personally use in or around earnings. I have talked to investors, and I believe, Sam, you might have done this at one point or another, where you sort of did a calendar spread like this, but the short call expired before earnings, and the long call was after the earnings. So the idea was to minimize the cost of the long call heading into earnings. So in this case, earnings might be on September 15th. So we take in that 242 to lower the cost of our long call down to 173. Our hope is that this expires, or it costs us a little bit to buy it back. Then we're left with a long call with a significantly low cost basis heading into the earnings, and we may be able to buy a put to create a cheaper straddle or strangle. It takes a lot of planning to do something like that. And of course, it could be very profitable, but if the stock swings one direction or the other before earnings, OLLI is a great example. It's a position I'm in. If I had opened up a horizontal spread a few weeks ago with selling, let's say, the 80 call and buying the 80 call further out with earnings coming up here on September 6th or September 5th, I think, September 5th, I believe. Well, the stock has moved up above $86 in just the last 4 days. Okay, so I would be in the loss range for that horizontal calendar spread on OLLI's bargain outlets. It's moved up significantly prior to the earnings event. I'm just in a married put, and I'm just letting the stock run for now, and I may roll up my put to bulletproof the trade, so I have absolutely no risk on the trade going to earnings. I've just been letting it run instead of keep moving up and moving up the put going forward. Okay, so that's there. Okay. Okay, and Sam, you had mentioned that UVXY, you had a winner on UVXY. You just got out of it for 11% gain. Okay. I am losing on my September 15th VIX call right now. I had actually rolled it. I'll just check real quick. So buying VIX calls is a way to hedge against the market. Oh, this was rolled. I had the August that I had a good profit on. I rolled that out to September 16 at 125. My actual effective cost per share on that is about 20 cents. Because of the previous profit. Right now it's at 70, but just by itself I'm down 55 cents or about 44% on the VIX call position. We'll see what happens next week. All right, moving on now to our active questions. Let's see, it's Khokon's here. He says, I tried to enter an SFIX, I'm not familiar with that one, naked put, September and October expiry found a profit probability to less than 20%. Can this be workable with such a low profit probability? Okay, I don't know what you mean. You say a profit probability to less than 20%. Does that mean you're looking for 80% probabilities, or you're selling deep in the money puts that only have a 20% probability of expiring worthless? I'm not real clear what you mean on that. You mentioned probability. I don't think you're talking about return. Let's take a look at SFIX. Khokon, I'm going to look at the puts only. Okay, and if I was going to sell a put now, I don't know this position, Stitch Fix, okay, it's at 40.58 up $2. For safety, I'm probably selling the 37 at about a 71% probability. I may go deeper. Let's go to the medium chain here, see what we've got. 89, 86, 81, 77. This is 21 days out. Standard expiration for September. The 36 at midpoint is about 70 cents. So that's a 1.9% yield for 21 days. That's close. But that's the 77. Here's the 80% probability. 82% probability of expiring worthless is what we want, but it's only 55 cents for 1.6% return for 21 days. Now that 35 strike, let's use the custom spread here, but remember, oh, sorry folks, remember these numbers. It's got an 82% probability of expiring worthless. The 20% is over here, the 46 at 615. So I've got the 46 in the money put, 615 premium, with only a 22% probability of expiring worthless. And I've got the 35 put, a 1.6% yield, and an 82% probability of expiring worthless. The time premium here is higher, isn't it? I'm selling it for 615, but most of that's already intrinsic value. The stock at around 40.50, I'm sorry. So, but we are getting roughly 73 cents of time premium, so that'd be a 1.4% naked yield. That's assuming the stock stays where it is right now. Of course, if the stock moves up above 46 and this premium goes to zero, it expires worthless, you've made $6 on a $46 requirement. Let's take a look at the custom spread tool on that, Khokon, because I'm not sure what you mean by that 20% probability. For me, of course, I'd be going deeper out of the money. Okay, when I sell a naked put, I go deeper out of the money, look for a probability of around 70, 75% or higher. My bull put spreads are usually 80% or higher in that case. But I want to take Stitch Fix, all right, and I'm going to go ahead and sell that September 35 put for the midpoint of 55 cents. Let's just put in one contract. Let us keep the math simple. Now this, of course, does obligate me to buy shares of stock at 35 if the stock falls below that price. I have an 82% probability of the stock expiring worthless, and for a 21-day trade, it's a 1.6% yield. Broker would require me to put up the $3,500 for one contract. Right? If the stock fell, I'd be obligated to buy 100 shares of stock at 35. So my broker would likely have me cover that margin requirement, but if you're trading on margin, it might be a little bit less as well. Okay, but in any case, this is looking at it as fully cash secured. True risk is 34.45, so we have a 1.6% return off of the margin requirement. 82% probability of making that return. Okay, now of course I'm going to take some losses and I'll try to manage it, but I'd probably use a stop order of around 7%. Now, let's look at the other gamble. Okay, I'm not sure again what you meant, Khokon, but let's take a look at the September. And a naked put here, we were looking at the 46.615. Okay, so we're going to go ahead and sell one of those at 615. Now, in theory, my margin requirement is going to be higher. Why? Because I have to potentially buy shares of stock at 46. And remember, I could be assigned at any time. And this only has a 20% probability of expiring worthless. I do collect 615, but I've got $4,600 of potential margin requirement where I may have to buy the stock. So my margin's higher at 39.85. However, if this does expire worthless, we get 615 off of 39.85, so that's a 15.4% return, which we might only get 20% of the time. My break-even's 39.85. The stock is above that, so we might make a small profit even if it stays the same. Sorry, what is that? 73 cents. That's the margin requirement. I'm sorry, that was the time value. You see what I'm saying? I know it's tricky, but look here. The stock stays right where it is. We'd still have to maybe buy shares of stock at 46 or buy to close our short put that's deep in the money. However, it would go to intrinsic value, $5.42. So we took in $6.15, so we have that 73 cents of time premium. Now, what's 73 cents on a margin requirement of 39.85? It's pretty much close to about 2% or so, isn't it? Right around that range. Okay, well, it's a little bit less than that, probably 1.9, close to the 1.6% we had. Let's call it around 1.9% at 39.85. Okay, now, why is that important? We looked at an out-of-the-money put that has an 8 out of 10, an 82% probability of expiring worthless for a return of only 1.6%. Selling the in-the-money put, remember, which you can be assigned on at any time because you're starting off in the money, might potentially yield 15.4% if and only if the stock's trading above $46. You're more than likely to be somewhere in this range, 2, 3, 4% gain if the stock falls. Okay? But in reality, even if you did get the 15.4% return, you're only going to get that 20% of the time. Here, I'm going to get this 1.6, 82% of the time. Is that relevant? Let's take a look. We do have that tool over at radioactivetrading.com, where, of course, we have the Fusion subscription. And in the resources section, there is the Trade Simulator tool. Now, in the Trade Simulator tool, we have put some default criteria together for you for using covered calls, credit spreads, and so forth. But let's think about our naked put position. I sell an out-of-the-money naked put and expect a 1.5, 1.6% target return. Now, remember, in the out-of-the-money naked put, the stock's trading at 40.50. We're selling a 35 put. So we're just at about 12% out of the money, maybe even a little bit more in this scenario. Why is that relevant? It's relevant because my loss limit, I could set a stop loss on the position of 10%. If the stock falls 10%, I might buy to close my short put. But depending on the time frame, I still may be at a profit even with the stock falling at 10% because it'd only be at about $36 and I've got the 35 put. Of course, accidents happen. Stock can fall 10, 15, or 20% overnight due to any bad event. So even if I put in a 7% stop on the stock, if it drops 20%, I don't get out of my naked put at the price where the stock was at my 7% stop or 10% stop. I get whatever the market can. So I'm occasionally going to take a loss. And that loss may be 7, 8, 10%. We're going to put in 7% in this case. But I'm going to put in a probability of loss of only 18%. I'm going to be right 82% of the time. I'm going to make 1.6% when I'm right. I'm only going to lose 7% when I'm wrong. Let's take a $50,000 account in that example. And let's put in 50%, $25,000 into each trade. Now let's do 25. Okay, we'll put 25% into each trade. Oh, okay. I hate when it does that. That'd be my fault. There we go. 25%. Good. Now, as you can see, if I'm right, if I started off with $50,000, at one point I have a small profit being right 75% of the time, but long term, I'm $8,000 down. $7,500. I need to be right more often. There we go. 81. Ooh, still not there. Okay. So what are the two factors here? I could either be right more often, look for higher probability. I could look for maybe lower probability, or I could try to control my risk better to 5%. That's going to be more difficult, but remember, I'm starting off 12% out of the money. So if I can do that, now we're looking at where we want to be. Okay. Oh, I'm sorry. This bumped it down again. I accidentally scrolled. Sorry, folks. There you go. 50,000 one more time. 82% probability of success, controlling the risk to 5%, and that's after 10% loss. So here at 85, yeah, we make about 8,000 off of the 50,000. Now, let's just take the raw numbers and reverse it. What if my probability of loss is 80% and I expect to make 15.4% when I'm right, only 20% of the time, and I still try to control my losses? And remember, if the stock stayed the same or moved up, I'd still have some profit. Not 15.4%, but I'd still have some profit on that naked put. But we're going to control our losses down to about 4%. Maybe we could even go less, but let's keep it at 4%. Okay? Now, here you were right 22% of the time, only have a small profit, but at one point, you did go really high. Strings of winners and losers. Here again, you only won 16% of the time. You didn't get that 20% winners, so you're down about $11,000. Okay? One more time here. Almost at 24, and you got that profit close to it. So this, to me, deep in the money puts are not worth the gamble for the higher premium. The time value is not even that high. Let's go back to the chain for a second. No, sorry, let's go back to the chain for a second on the puts. See, this one does have a 73 cent time premium, which is about equivalent to the 36, which has a 77% probability. I'd be more apt to sell the 36 strike put, be right 77% of the time, as opposed to looking at this, understanding that it might be about a 15% return if I get the full 630, but I might only see that 20% of the time. Again, that's why we talk about at to slightly out of the money put options or deeper out of the money put options, okay? And again, this is a good comparison because Khokon says it's a good example. I was thinking I was in the range. I was looking for in the money puts. These are out of the money, actually. When you're below the stock price on a put, you're out of the money between 30 and 40. Now it becomes a question, of course, which probability best suits your needs and which return suits your trading plan. I have a feeling that for 21 days you're going to be in this range. The 37, 2.6% return is 72% probability. 36, 1.9% return with a 77% probability. Safer side's the 35, 55 cents, 82% probability, 1.6% return. Argument could be made for the 34, 1.2%, 86.2% probability. Not a bad trade. If you're interested in SFIX, you wouldn't mind owning the stock long term. You wouldn't mind converting it to a collar or a married put play. If you did get assigned, I'd say go with the better premium. Why not take the chance? Maybe go up to the 39. So if the stock does fall to 38.50, 37, and you get assigned, guess what? Your cost basis is 37.55, 37.45. Because you keep the premium, you buy the stock at 39, you're still in this cost basis range. Now you can convert it to a collar going forward if you're still bullish. You can convert it to a married put if you're bullish longer term. Or you could just trade it as a covered call depending on your risk tolerance. Okay? But for a trading plan, cash secured naked puts that you're hoping to expire worthless, as you don't want to be put to stock, but you want to try to generate whatever your trading plan is, it should usually be around 1.5 to 2.5% for a 30-day time period. We're at 21 days. I'm comfortable in this range. Personally, I don't see a real problem with a 37, a 72% probability, 2.6% yield. But I wouldn't go any lower, because any lower than 33, now is that question, is 30 cents worth it? 20 cents worth it? Now I want to be in the 50 to 60 cent range minimum, but I still want to be in this probability range, maybe 75% or higher personally. You've got to develop your trading plan, but that's what Ernie and I look for. Good probability of expiring worthless, decent premium. And of course, with the weeklies, our average, going 7 days out, I might look for an average of 0.9 or 0.8%. I think that's pretty good. Going 21 days out in time to 30, yeah, I'm 1.5 to 2.5%. Based on the volatility where the market is right now, I think that's a good average return across the market for out-of-the-money cash secured puts. You're still looking at 70% probabilities, 66% probabilities. But again, I prefer to be in that range. The balance of going for the higher premium, only being right maybe 14 or 15% of the time, doesn't really get you ahead, all right? You're still going to take losses from time to time. Once in a blue moon, you're going to get that high return, 15, 16%. The other times, you're going to be somewhere in the middle. Okay, so you're not going to be getting that probability. But that's why we look at those examples there as well going forward. Okay, all right. Now, argument was made. Is this Jim? I'm sorry, I'm going through some of Sam's comments. Oh, Sam did say, good afternoon to all in the room. Sam, I'm sorry, my questions are going in reverse order. It looks like the ones that you commented earlier are appearing at the bottom instead of at the top, as they usually do. Sam's trade in CGC that we talked about a little last week. I showed it last week, Sam. I showed the CGC chart last week. We mentioned that you had some profits on the straddles there, moved up to 32. Yeah, you didn't manage it by selling a put. You just got out of the straddle, and I think you rolled to another straddle. Good. So it's a good position. That was an interesting mover there, the CGC one as well. And then other ones you're looking at, EDN, TLRY, CRON, and SUPV. All right. Okay. Okay, sorry. I got sidetracked there. I do apologize there. Jim had said that, well, he was referring to the comment I made about selling closer to at the money for this 155 premium at 39 with about a 60% probability. He said, well, if you wanted to own the stock, what's the harm in selling one of these in the money ones? So if I get assigned early at 46 or 45, my cost basis here at 615 is going to be 39.85. I'm still below the current stock price. And you know what? He's right. And you could be assigned at any time. Difference is the margin requirement. Remember, the margin requirement here was 39.85. Here it'd be 38. I'm sorry, it'd be 37.50. I know, not too much. They're only $2 off. And here, when we were at the 36 strike that I was looking at, or the 35 strike, I'm sorry, it would have been 34. So it does come down a little bit to margin requirement, ROI. But again, Jim has a point. I'll agree with that. If I am interested in the stock and there's a decent enough time premium, 138, 170. Personally, I'd probably sell the 41 at 223. If I wanted to own the stock long term, and I said to myself, hey, this is a good time value premium, let me get in here, 220, 223, that's the time premium, right? There's still intrinsic value here, but 223 is the time premium that I'm comparing to the out of the money value, which is all time premium. Jim's right. If I wanted to own the stock, why not? I could get $1.70 now of time premium at the 42 strike. The stock stays right where it is or only moves up $1. I buy it at 42, but I'm keeping this 280, 310, 305, 310, 315, excuse me. But that's 170 off the cost basis. So I essentially bought the stock at 40.30 that's currently trading at 40.85. I can see that if you wanted to own it long term. There's no problem there. But again, remember, stuff can happen. If there was a 10 or 15% drop on the position, this puts 14% out of the money. It still wouldn't be put to me if my sentiment changed because some unexpected event happened. Here, I get the stock at that lower cost basis of, I'm sorry, what I say, 315, I'm sorry, so it'd be about 38.85, good price, but if the stock fell that 15% and is trading at 34.50, I've got a 450 loss. That is taking into account the premium that's already collected. So I also want that protection in case there's a bad market condition, in case there's a black swan event. I've given myself that cushion, that boundary, rather than getting put the stock at 42 now with a cost basis of 38.85 on a stock trading at 34. Be easier to get put at 35 with a cost basis 34.55 on a stock now trading at 34. Okay, better protection, better buffer. But Jim, you have a point. If you are really bullish, if you want to get into the stock, you just want to get a $2 or $3 discount, what's wrong with selling right at or slightly in the money if you can get the time premium you want? Nothing. It's just that if the unexpected happens between now and expiration and you see a 10 or 15% drop, you got a better cushion and better protection here with the out of the monies, but you'd still get into the stock at the price you wanted. So can't argue with that if you're planning on it long term. Hope that helps you, Khokon, with that discussion there as well. Now, Fernando followed up. Fernando said, is it a good idea to sell an in-the-money call to defend the sold in-the-money put in the case of a stock decline? Is it a good idea to sell an in-the-money call to defend the sold in-the-money put instead of a stop? No, I don't think so. First thing that popped into my mind, as I read your questions, I sort of try to think through them. The first thing that came to my mind, what you're going to do in that case, Fernando, is you're going to create an in-the-money short strangle. Okay, ITM short strangle. Okay, so we're in this position. We sold now the in-the-money 46 put that has a time value of roughly 73 cents, but we did get a $6.15 premium up front. Stock falls down to 43. I'm concerned it's going to fall further, so I say to myself, why don't we sell the 39 call? Oh, I'm sorry. Let me rephrase that. Let me do that again. We've sold this deep in the money 46 put. The stock falls from its current price to, let's say, 38. And I decide I want to protect it by selling a 34 call. Okay, so when the stock fell to 38, I'd sell the in-the-money 34 call with the in-the-money 46 put. It's already sold. This is about 4 points apart. Why is that important? Well, because I'm going to use that as a gauge to what it might be. Rather than use a Black-Scholes pricing model, which I could do with a few clicks right now, I'm just going to do this. All right. Right now the stock's at 40.58. 4 points out of the money for September expiration would be about the 36 call. All right. Currently trading at 5.45. Midpoint. So if the stock fell to 38 and we are considering the 34 call, after some time value, a price of 2 points in the money still, I'm sorry, 4 points in the money still, but a price of around 5.20, 5.15 would not be unheard of. Okay, so let's do it. Random scenario, stock falls down to 38. We're concerned. We sell the 34. I'm sorry. Call to help hedge this position. We get about 515. So we got about 1130, excuse me, premium into this position. What happened? How is that not profitable? Even with 1130, not 1230, 1130 premium, why is it not profitable? Because your spread's 12 points apart. You have to cover that loss. Okay? What would happen in this situation if it ended up between? You get put shares of stock at 46. You have an obligation to deliver them at 34. So at a strange instant, I don't know how your broker would handle this, how you want to phrase it, but you're put shares of stock at 46, you've got a short call, guess what happens? You're now in a covered call where you paid $46 for the stock, collected $11.30 worth of premium, so you have your cost basis of $34.70, but you've got a short call, so you've just created a call. You've just created a covered call where your cost basis on the stock is $34.70 and you're selling it at $34. Premium's already taken into account with $11.30, so you lock yourself in to a 70-cent loss. We could look at it reverse and say, oh, well, if you're assigned the short call at 34, if the stock's anywhere between here, we're now short stock at 34. We've got a 46 put. Now you're in a covered put position. So you essentially buy shares of stock at 46 to cover the loss at 34, 12-point loss, keep the 11.30 premium, there's your 70 cents. And if there's a large gap one direction or the other, you've got significant losses to the downside. Frowny face, don't want it. Okay, so I don't think that's a good idea. Now, the only way that would work, and the margin would be steep. Remember, you're in an in-the-money short strangle now, so you've got a large monetary requirement of this position. Okay? This will work, and I don't know how well, but this will work, Fernando, if and only if the ITM call you sell has enough premium to where the total premium collected for your in-the-money put and in-the-money call total premium has to be greater than the difference of the call and put strike price. So in this case, if I could have got 515 for the 35 call, had 1130 in premium, but only had an 11-point strike difference, maximum profit of 30 cents, same requirement of about $8,000. Is that matching your trading goals, though? No, I don't think so. You're looking at less than about a 0.4, 0.5% return on the position as a defense if the stock falls, selling it in the money call. Okay? So, because remember, as the stock falls, your premiums are going to be dropping. So you've got to find a strike where now the new total premium will be greater than the difference in strikes. I don't think that's how I would manage this position entering into the short strangle. Okay? All right. All right. Okay, I'm sorry, and this is a different point Sam brought out, and once again I apologize. Everything was backwards there. Okay, backwards order, I should say. So Sam did mention broker likely would not accept the order in this case. The reason why, because you have to be, if you're approved to sell naked calls, you have to have that $100,000 in cash. Okay, and I don't know Fernando's trading size, but Fernando's right. Adding this in-the-money call to protect an in-the-money put does create an in-the-money strangle. But as a leg in, your broker would see this automatically as a short call, a naked call that's not covered by another call to create the vertical spread or calendar spread. So if you're not able, you don't have level 4 trading, you're not going to be able to do the short strangle to begin with. You're also not going to be able to sell the naked call. Could you do a bear call spread? I'm sorry, could you do a bull call debit spread was the follow-up question. Sure, but now you're not getting 515. If you sold that 32 for 515, and you sold the 34 for 515, you bought the 32 in this case, maybe at 3, you're only getting another $2. Right, you're paying a debit to get into it, so you're not getting a credit in that case. Wow, I am completely thinking backwards, folks. I apologize. If you created a bull call debit spread to try to protect the naked put, the in-the-money put as the stock falls, that kind of doesn't make any sense because you've now done 2 bullish positions. Okay? This would avoid the requirements of being level 4 trader where we're just doing the naked call. But see now, what I meant to say was I may get 515 for our 34 call, but I'm probably paying closer to 650 or 670 for the 32 call. So I'm actually paying a debit now of maybe 180, so we really only have $500. Now, if the stock stays above 34, I get that other $2 back. So it's close to getting the 515, or I'm sorry, the 1130 total. But you'd be paying a debit to get into it. Okay? And now you've got a double bull trade with infinite risk to the upside. Okay? But it would avoid that naked call issue, but you're not going to get that second credit. You're going to pay a debit, which lowers this down to $4 or, $3.85, $3.75, $3.60, whatever. And then you could get that $2 back between the strike prices here if the stock's between them, but then you're still at this point. And if it goes up, yeah, you make on both, but you've changed the dynamic of the position. Okay, that's the rule of thumb. But Sam's got a point. Unless you're level 4, you can't do that as a protection. That's not a good, I'm sorry, that's not a way you're going to protect it. Yeah, you want to buy, yeah, Sam mentions that you want to buy, in order to protect the risk to the downside. And Fernando says that you meant before the drop. Well, if you can time it right, all right, here's my thought on that. You're saying, could you do this if you're qualified to do it? If you have level 4, you can sell the in-the-money call as a naked call. But Fernando says you do it before the drop, okay? Meaning that before I do anything, stock's at 40.58. I haven't sold, let's say, this call yet, but I think the stock's now going to drop for whatever reason, whatever charting I use. I say, I think this stock's going to drop. I want to sell an in-the-money call to protect this, so let me sell the 42 call. Honestly, that we just saw that doesn't protect it. It still has a full loss, right? It still has a loss to the downside. That's not a way to go. Okay, so let's say now though I sold the stock wavers for a little bit at 40.58. I sell the 42 call for $2 on this position before it drops. I still have an in-the-money short strangle that has infinite risk to the downside. Okay, I didn't solve that problem. My lower break-even's at 38. That's not that far. Okay, that's not that good. And if I sell it before, and if I sold the 38 now and got maybe 250 and then it fell, you might have a lower break-even. Let's just take a look at that. Let's see, I sell a 38 call now for about $4. Probably puts our break-even around 36. Yep, right at 36. Okay, so if the stock falls now to 37, you still have a profit. All right, I got to tell you, why? Why do that? I mean, you give yourself a cushion, I get it. You lower your break-even down to 36. I get that. The stock only falls to 37, you have a profit where you would have had a loss on a naked put position. I get that. But if you think the stock's going to drop, just get out of the original position, even if it's at a loss. Why put yourself in a position where you can still have infinite loss? You give yourself a little bit of buffer in this range, but you're still potentially buying shares of stock at 46 that are now trading at 37, 38, 35, or 34. Just get out of that. Don't overcomplicate it. Don't put yourself in a higher margin requirement. Double it. You're doubling the margin requirement by doing this for a little extra premium and a little extra hedge, but you could still lose if the drop is more than you thought. You can still have, okay, good profit here, but not that much, right? It's not the 615. If the stock stays between the strikes, we've gone up from 73 cents to $2, okay, but I get out of the first position. If you're in a bullish position, a naked put that's in the money, a long call that's in or out of the money, doesn't matter, but your stock chart says you think there's going to be a crash, get out of that position and convert it to a bearish one. The main crux of the position, Fernando, that we are in, selling that in the money naked put, is still a neutral to bullish position. This is extraordinarily bullish because the max profit doesn't occur until the stock goes up to $46. That's about a 15 to 16% increase from where we are right now. This is an extremely bullish trade. If something in the charting or my market sentiment gives me the sense that I feel the stock or the market as a whole is going to drop 5, 10, 15% in the next 5, 10, 20 days, I'm just getting out of this. I am taking the bullish trade off the table, and then I might buy a put. I don't think I'd sell a naked call in case I'm wrong, but I would do a bearish position. Bear call credit I would do. Bear put debit maybe. Buy a put. Buy calls on the VIX if I think it's market wide, if it's low enough right now to begin with. But I'm not going to take this position and say, oh, I'm going to leave. My sentiment is now changed to where I'm bearish. Let me leave this extraordinary bullish position open and try to throw some more options on top of it to where if it falls 5%, I could have less of a loss, and if it does this, then I could have less of a gain. Don't overcomplicate it. Just get out of the bullish trade. If your sentiment changes, get out of the bullish trade. Now, going into another direction, okay? Sam says, well, I'm sorry, Sam has add a couple of comments here. I don't know, Sam, there we go. Okay, sorry, folks. Sam had said, how do you know if the stock will drop? I'm not sure. We'd have to ask Fernando why he thinks SFX, it wasn't SFIX in this case, but what indicators would you use to think that the stock would drop? I think he was talking about in general as a structure. And yes, one has to look at the support and the resistance and MACD as well. And Sam brings up a point. He says, I'd rather have a radioactive trade and if needed, do a collar. And that's what Fernando has been doing with his positions. Would it work though? Where's a good one? This are mostly my trades. This is one that would have worked and I should have done. Had a couple of questions this week about customers who asked me, you had mentioned in one of the webinars, and last week we talked about it as well, you had mentioned about using a mental stop on some of the positions. Why not use a hard stop? No, it depends on the strategy, okay? But at a married put, I'm usually not overly concerned about a large decline. I'll wait till the decline bottoms and then make an adjustment if I have enough time. I'm going to admit complete failure on this trade. This is Interactive Brokers. This is one of my married put positions. I'm going to admit failure on my part due to lack of timing and not following my own guidelines. Okay? What do I mean by that? Let's go back to the 4 month. I got to go 6 months. But 6 months will be okay. I think I got in to Interactive Brokers here-ish. Maybe it was a little bit before. Maybe it was back in February, but it was around this price, I think, of about 62, 63. No, it was higher. It was $65, $66. So it was somewhere in here. Stock did exactly what I wanted in the first couple of months. Hit at 80. I rolled up to the 70. I had the 70 put to start with. I rolled up to the 75, sold a call. That expired. Rolled up to the 80 put, have a 1.5% risk. And I put in a mental stop that once it hit 77.50 After it was up at this 80, it came down almost here. And I said, it came back. I said, no, it's still going to go up. And I put a stop here at 77.50, and I didn't follow it. I should have liquidated this married put, not continued to trade it. Should have sold the stock at 77.50, sold the 80 put for around $4. My total cost into the position was only about $76. So I would have made about 83 on 76, about a 10% return on it. That was sort of my target. Now, two things I should have done. I should have closed there. That's number one. Since I didn't, I read the MACD a little bit wrong, so I was waiting for it to go all the way below the Bollinger Bands, but it kept giving me these false signals. Too many. Okay? I should have just stayed with it. What I should have done here is done a second put, or sold to close the stock and left the long 80 put open as it went down to 58.59. So, I did sell another call in here. No, I'm sorry. I sold a call here instead of closing it. That was smart. I sold another call here but didn't get much for it, and I haven't done anything with it since then. Okay? It has started to look like it wants to come back up. It's just not doing too much. What I'm likely going to do is sell the 65. If it continues up, I'm going to sell the 65 call that's out of the money to get it to no win, no loss. I'm not going to continue this trade, honestly. So any of the Fusion subscribers, I'm not going to sell to close this September put that I have and then try to open in January or February and continue this trade. I want to get out of it. There's better money to be made out in the market, but I'm going to take this to a no-loss position if it continues up. If it doesn't, I'll take the 1% loss. Now, why am I babbling? Okay, well, let's take a look here. At this point, I had a 1.4, 1.5% maximum loss, and started to worry about a downturn here, which would have been around June. No, 70 here. Let's go end of May. Okay, so probably I would have sold a June or July in the money 70 call at the end of May. End of May, June, July, 70 call ITM. I probably would have gone to July, because honestly, the Junes I don't think wouldn't have had enough time premium that deep in the money. All right, let's do two things very quickly. I'm going to go back to the portfolio. I want to see what the Interactive Brokers position would have looked like if I can go back that far on this account, which actually now I don't think I can, but that's okay. Let's go to IBKR. There's my 1.5% risk. I think I got another dividend already on this, so it's maybe 1.3, a little bit lower. I'm going to go to the option chain now for IBKR. And this is the trial account, remember, so I might only be able to go back to June. All right, June, can I only go back to June 31st? Let's see how many days I have left here. All right, it's thinking. So I'm using the historical chain. It really doesn't like that, does it? All right, so I'm using the historical chain, but I can only go back to July 2nd because I'm on a trial account. Tell you what, hold on 1 second. I'm going to do something else here. 1 second, folks. I'm just going to go back to somewhere else. All right, so what I'm going to do, off screen, I'm going to go to my real account here. Sorry. Anyway, I'm just going to grab what that price is. Okay, I can't do it on the trial account. On the trial, we give you the availability to go 2 months back in time historically, but you have to be subscribed to the historical tools to go back to April of 2006. So let's just say on or about May 30th, May 31st, go May 31st is available. Okay, oh, sorry. And I'm going to look at the July. Sorry, folks, there we go. There we go. Let me know when that comes up, folks. All right, there we go. I'm going to look at the July 70, 5 points. Not too bad. I'm going to call it a midpoint of 495, actually, 480 to 510. I know it's smaller, but 480 to 510. Okay? So on May 31st, I could have sold the July call. You know what? I am going to call it $5 even. Okay, we're just going to call it $5 even. I apologize. So what would that have done to this position? It would have lowered my cost basis down to 70.07. Okay? And right now, July would have expired, so I would have 5% profit on it. That would have worked. But you know what wouldn't have looked right? I got an 80 put in play. The stock's fallen. On May 31st, we saw the chart here. It was right, yeah, it was dropping right below 75, so we were going to sell the in-the-money 70 call for about 510. Wow, so we were right at intrinsic value, weren't we? There wasn't a lot of time premium on that, just a lot of intrinsic, and luckily it kept dropping. Let's take a look at now. The structure would have been similar with the same setup. Oh, I can't do that. Well, it's close. Okay. This is what it would have looked like on July expiration had I sold the 70 call for 5 points. Okay. If the stock was below 70, we would have had a profit. But if the stock recovered and went up, I have a loss of 8.2%. Now, this is looking like a collar. This is a bearish collar. I know that, and that's because it's at the same difference. It's the same expiration, right? Because we were trying to fake June to July with having the September put. So let's change this to a December 80 put, 565. Why? Because now the Black-Scholes models and the equations will look the same. So the risk is still 8.2%. In this case, with the stock below 70, I'm at a profit. You're absolutely right. It would have been a decent play. But had it been a whipsaw, which we discussed last week a little bit with the bull-put credit spread and managing bull-put credit spreads when a stock whipsaws, if it now had dropped to 74 and 73, we sold the 70 call and then it started to move back up. Now we're into the loss range where we would have been at a double-digit profit. So you're right. If it keeps going down, that's true. But if I thought it was going to keep going down at that point, when the stock was at 74.90, I could have also just closed the stock, added about $1.65 to my cost basis here to make this about 730, 725. Now I'm holding a December 80 put. That's looking much better, isn't it? This goes back to what I was saying. You're in a married put that you were bullish on, and now your sentiment has changed. Selling an in-the-money call would have gotten me to a profit on this position. Had I looked at it and decided that, yes, I am now extremely bearish on this position, I think it's going to drop from 75 down to 58, I either would have done income method number 12, I've been looking right now at a profit of around $1,100, $1,200, or I could have sold the stock, added just $1.50, $1.60 cost basis to my put option, and be at about $1,100 profit right now. Don't, if you're in a bullish position and your sentiment has changed, don't force a bearish trade. Selling an in-the-money call, an in-the-money covered call is protective and is kind of neutral to bullish, but in the married put, it's actually bearish. If your sentiment has changed to bearish, get out of the trade that's bullish. Adjust it so that it's now bearish itself without adding more options to it, or add an option to it that gives you the profit to the downside, not just protection. If you've really changed to bearish. If you don't know, I don't know if I'd sell the in-the-money call. Think about it this way. We add that position back together. Let me see if I can just go back to get our in-the-money covered call back. Oh, shoot, I wanted to go forward one. I'm sorry, folks. Try this again. That's the September. Did it run the one before that? Yeah, there we go. This position, May 31st, stock's at 74.90. We want protection, so we sell the 70 call. What happens if it stays right at 70, 74, 73? It didn't continue down. we now have to deliver the shares of stock at 70, and our put was losing time value and decaying. Okay, that wasn't a good move. We're right in this middle range. If it moves up, now again, we don't get any advantage of owning the stock because we sold the 70 call. So that's countering the gain. And we're losing money on the put. Got to be really sure it's bearish to try that. That's why we say never sell. In this case, we see it would have worked. But the risks were there, and to me, the risk didn't outweigh the benefit of doing it. I should have closed the position at 77.50. I should have done income method number 12 at the point we're talking about, or sold to close the stock. That was the better play. Selling the in-the-money call would have made me a profit right now instead of a 1.5% loss, but if the stock had moved up, I would have taken my potential loss up by 7 times what I have right now in just the married put. I don't think that matched my goals. That's why it wasn't done. Okay, a lot of things have to go into this, and Sam's been commenting on those, and a couple others have too. The idea that you've got to look at everything, the market, the technicals, everything along those lines. They all have to come into play when trying to pick which direction the stock is going to go. Oh, Sam, you got out of AOBC, 96%. That's good. That's a good. That's a fantastic return. You had some bull puts there too. Okay, so give me 1 second. All right, Rhajiv, I just saw your question. I'll get to that in a moment. Okay. All right. All right, some comments there on that TND stock we mentioned, or TNDM stock we mentioned. Hold on. Here we go. And 37% okay. All right. Khokon, you had mentioned. All right. Let's see here. Okay, good, good. Okay. Oh, yeah, and there's Sam. I'm sorry. There's Sam comments. Stock's going in that direction. Oh, and Mark's got a valid point. Let's see. Mark, so during this interactive brokers, he said, ultimately, doesn't the put save the trade on interactive brokers? Yes. My original price before any adjustments or any income methods on the stock, let's clear everything out. Well, the original position itself, oh, let's just walk through it. I'm right here. I'm sorry. Let's just walk through it. And there we go, interactive brokers. Okay, so the original trade done on February 16th, stock was at 67.72. I paid $7.20 for the September 70 put for a 6.6% risk. First income method number 4, rolled up the put. The stock had moved up. Okay, so I lost $240 on the put. It was only worth $480, but sold to close that at $480, bought the other one, paid $240 to get 5-point higher payout, cut the risk in half. Exactly what I look like with income method number 4. There's 10-cent dividend on $330. Risk was down to 2.9. Got the risk down here to 1.8%. That's when we rolled up to the 80 strike put. So now we're at that 1.8. Oh, maybe I did record it. Oh yeah, 7.2. I'm sorry, I did record it. Got the other 10-cent dividend there. So that's what's got it down to 1.7. It's actually 1.5. The 1.7 here is including commissions. So I guess that is more realistic, is 1.7%. But again, bought the stock at 67.72. Trading at 62.16. We're down $5.60, or roughly 8% on the position. The stock's down 8%. After going up to 80 and then coming back down, it's down 8% from where we bought it, 9% from where we bought it. I'll tell you that right now. It's 8.2% from where I got in. My loss is roughly 1.7% on the position. Again, if I can get, which I can't right now, it's only worth 30 or 40 cents. I looked today. I looked yesterday. Not selling the in-the-money call. I'm not going to sell a 61 or a 60 call. But if I can get 95 cents for the 65 call on this position, I'll have a profit. Even if it stays just below 62.5K. Yeah, it's probably not going to recover in the near term. This is a huge choice I have to face, Rhajiv. I'm waiting now I could have gotten out a little while ago, not for much better, maybe only 1.3, 1.4% loss. It's so deep in the money. It's better to trade a neutral to down strategy, right? There's just not that premiums left, and I'm not that much premium available for the September expiration, and that's the position, that's the put that I'm holding. So I'm likely going to close this position unless I see in the next week or so that 65 call get up to 90 cents, 95 cents. Then I'll get rid of it. It'll be close to a profit or a small loss of only 0.2%, and I'll be perfectly fine with that. So you're right. I don't think it's going to recover by the time I get out of the trade. I'd rather use this money in something else, like the 5 stocks Sam is sending our way that we mentioned earlier, that he's had a huge gain on in the past this trading week as well. Let me check the attendee list. Michael, are you still here? Michael had mentioned, I do apologize, it had come in earlier. Michael had asked you hold the spread to expiration. I will hold the vertical spread to expiration. Okay, if I'm in a bull put credit, bear call credit, if it's not been threatened, I will hold that as long as I can, hopefully have it expire worthless. With the diagonal spreads, even if they're only 1 or 2 weeks apart, remember, beginning of our conversation, the horizontal spread or the calendar call diagonal spread or the horizontal spread, I usually get out of those before expirations, rolling the short call one direction or the other. Rhajiv has been talking to us the past couple weeks about spreads that are calendar spreads, either diagonal or horizontal, that are 1 week apart or 2 weeks apart. I'm usually buying a call that's 3 months out in time and selling a call that's 7 to 14 days out of time, usually more along the lines of 10 to 14 days out for my diagonal spreads. I don't trade horizontal spreads because I don't like that risk-reward profile, as I mentioned. I don't like the risk-reward profile, that tent profit and loss chart for calendars. Iron butterflies, excuse me, all call butterflies, all put butterflies, short straddles. Well, not even qualified to trade short straddles, but I'm just throwing it out there. I don't like that profit and loss chart. Okay, I don't like that peak profit and loss chart. We have a tight upper to lower break even though you could have 100% return. Remember what I said in the middle of the presentation, when you look at that horizontal spread or those butterflies, you're only going to get that maximum return maybe 5% of the time, 10% of the time if you're lucky. The other times you're going to have a little bit of gain, a little bit of loss, maybe 20% of the time you'll have a good gain, but not near that peak gain, and then 3 or 4% of the time you might have the large loss or the maximum loss on the iron butterfly. It's just not a trade that really matches my risk-reward tolerance. I know people can be successful with it. I am not that investor. All right. With that in mind, Rhajiv says, hey, Mike, for any Condor trade, if the stock moved to outside the range, then inversion will be best strategy. Do you agree with this? If not, what are other options we can use? Okay, so great question. Whatever. I'll just use SPY. I'm sorry. I was trying to think of a good stock, and I'm just not going to come up with one. Now, when you're talking about an options inversion, I believe you're talking about converting the spread that's being threatened into a new spread, right? Let's take a look here. I'm just going to go close to standard September expiration. I'm sorry, for SPY, 21 days out. I'm just going to create a Condor on the fly here. I like those numbers, 285, 283, 295, 297. You can say those are pretty close, and you're right, because, well, it's a Condor, so I'd be doing it as a neutral position. I'm going to sell a 285 put, I'm going to sell a 295 call, do a 2-point strike difference. Way too high of a return. I should go further out of the money, as you mentioned. Okay, but, you know, $60 profit premium there. Break-evens aren't too great. 5 points up, 5 points down. We could go further, but let's just look at the profit and loss chart, okay? All right. Now, I guess I said that wrong. All right. So, inversion usually refers to stock moves up, bear call is being threatened, so I sell a put, not necessarily a spread. but I sell a put either above my short put or sometimes above both, which I don't know is a good idea. So my call side is being threatened, so I sell a put, so if it keeps going, I've generated some premium here. And if the stock falls, I sell a call, lower strike than the put or a lower strike than both puts, depending on what my expectation is, okay? If the stock moved up, we sold this 295 put. Let's say the stock moves up to 294, and I'm concerned. So I'm going to go ahead and sell the 296 call, same expiration month. The stock's now up to 294, hasn't breached my short call yet, but is being threatened. Okay, and I'm going to sell a 290, I'm going to buy, what am I doing? No, I'm not. I'm going to sell the 296 put. Now, this is the stock was above 294, so I'm probably going to get 220, maybe 250 for that. Okay, all right, so let me clear that out. And we're going to sell this 296 put. So here's our Iron Condor. Stock's moving up to the call side. If it continues up, I'm selling a put that's slightly in the money for a good premium, I said about 250 or so. Okay. This is sort of an inversion, and now it puts the profit and loss up here. Is it the best repair? Well, it's a repair if you're right, and the stock continues to move up. The break-even's now at 292, okay? So remember I said at 294, so you're at a profit here, and then it does this. This does look pretty good. You've tripled your margin requirement because now you added a naked put onto that position. What was only a 2-point spread, I'm sorry, you've more than taken your margin requirement up by about 100 times. My apologies on that. We had a 2-point spread. By selling the put that's not covered, only one of these two puts can be covered by the long put, and it's going to be this one that you sold earlier. This is now a naked put. Your margin's up here. Okay, so you have a small profit potential here in this case if it keeps going up. All right. If it whipsaws, like we talked about last week, and you're wrong, and it goes up to 294 and you panic and you sell this put as an inversion because the call side on the Iron Condor is being threatened, but now it starts to drop. Oops. This is 3 times the maximum loss you had if the stock goes back to where it is right now at 290. 3 times the loss. If it goes further, well, why don't you sell a call here and do the inversion here, and then if it comes back up, now you're losing on the naked put, you're losing on the naked call because you put an in-the-money strangle inside of an Iron Condor. You lose on that side, which had the highest margin, which would wipe out the small net credit you took on the Iron Condor to begin with. We're still in no man's land. Okay? So, looking at the graph, are you right? If the stock goes up to 294, you sell the 296 put on top of the bear call spread, the threatened side. Does this get you to profitable? Yes. Takes your margin up significantly and 0.7% return. It would be profitable, but takes the margin up. If your sentiment has changed, maybe consider buying to close the short call, leaving the long open. Maybe consider just moving the bear call out if you think this has moved up, but then it's going to stabilize and move back down. Or just get out of the bear call side, move up the bull put to get a higher profit. Is it worth adding the extra leg to the inversion to take your margin from what was $1.40, $140 per one contract, up to $29,689 in this example? My answer is going to be absolutely not. That does not look right to me, okay? Okay. Now, Mark says the classic inversion is to move the whole spread, no naked short options. So the risk is still limited in both directions. I don't call that an inversion, though. I know people call that an inversion, but you didn't really invert anything. That's why I don't like the term for it. Okay, Mark? We can use that. That's fine. But when I hear inversions now, that people talk about repairing broken wing butterflies by adding an extra short option for an inversion. Selling puts above calls or calls below puts when managing a short position such as Condor, Butterfly, bull put spread, bear call spread. The classic inversion is to move the whole spread. I just call that rolling it out. And you're right. That's the first thing I would look to do. But Mark, I might not move the whole spread. Okay? In the standard Iron Condor position, what I would prefer to do, just like, you know, the 7 ways we talk about of managing the bear call, I use those same techniques in this case. If my bear call is being threatened, what are my options? Depending on my outlook, I might just close the bear call side, close the spread, and then move on. So take this, and if it's at a loss, it's at a small loss. I'll let the bull put expire, look for a better position. Oh, sorry. So 1, close the threatened side. 2, you know I always leave at least 1 full strike apart. Usually 2-point spreads are my favorite for verticals, including Iron Condors. Depending on the situation, stocks at 294. I may just buy to close the 295 and sell to open the 296. Give me a 1-point spread here. It'll be done at a debit, but as long as the whole trade is still profitable, I've given myself a little bit more cushion. So 2 is just roll the short leg of whatever's being threatened. 3, again, I was neutral. Now something happens that I'm bullish on. I'm directional. I'm now bullish or bearish if the bull put side is being threatened. Buy the short that's being threatened, leave the long open. You now have a bull put credit spread with a long call. Okay, infinite upside, but you would have increased the cost because that would have cost you more. And what if you're wrong and it pulls back down? Well, now you're going to be at a loss. What if you roll the short leg up and it moves back down? You're still at a profit. What if you close the whole position for a loss and it goes back to where you wanted? Buyer's remorse, better than being wrong and having it go up and taking the maximum loss. Okay, oops, sorry folks. Number 4, I know that's very small over in the corner there. So we had close the spread, take the loss, and move on. Roll the threatened side only up in strikes, depending on how much time you have. The inversion, as you mentioned, but I wouldn't do the whole spread at this point. I would just, if I still had time left, Mark, I would just roll the bear call side if that was a side being threatened, leave the bull put alone if it was still profitable. Roll the short leg up 1. Buy the short back. Okay, so I guess rolling just the bear call, if we had enough time, that would have been number 4. Is just roll the threatened side up in strikes, like the inversion, but not the whole spread. 5, if I'm out of time, 2 to 3 days left to expiration, now my bull put's being threatened, that's when I might move the whole spread and re-bracket it. I use that term in collars, Mark. I think you and I have talked about that before. But instead of re-bracketing the collar, I'm going to re-bracket the condor. So now the stock's at 294. I might be doing the 289, 287 spread, bull put, and the 299, 301 spread on the bear call. So move your Iron Condor to higher strikes. Now the trick with that is it's still going to cost you money to close this spread for a loss. So the new spread will be higher strikes, but just like rolling up 1, you're going to lower the return. Okay, it might still be profitable, but the return is going to be lower. If you needed to increase the return, you're probably going to take your spread, let's say it was originally a 20 or 14 day out spread, you may have to roll the condor out 2 months or 3 months in order to get it to be a credit. Okay. A pendulum adjustment could be used. What do I mean by that? You've got a bull put credit spread combined with a bear call. Right? So there's a bull put. Here's a bear call. The pendulum adjustment, the bear call. The pendulum adjustment consists of me selling to close my 297, buying to open a 293. So I move my long call down in strike to create a bull call debit spread with a bull put. 1 option move. Stock has now changed. I'm no longer neutral. I'm bullish. 1 option move instead of 2 or 3 or 4 adjustments. And now I've got 2 bullish spreads, and if it continues up, I double the profit. That's also a possibility as well. So I don't think what Mark said with the classic inversion of moving the whole spread up is necessarily the best way to go based on what Rhajiv asked. He said, is that the best way, is the inversion the best way to manage a condor? I'm not going to say that because it depends on the circumstance. Is the way that I've seen the term inversion being used as it relates to four-leg positions such as butterflies, condors, and broken wing butterflies by adding the naked option in to the existing spread, that can work. I don't think it's worth it to increase the margin. I'd rather, if I'm now bullish on it or I want to generate some premium, I'd rather move my short leg up one, which I could still lose, which that inversion I showed wouldn't, or what selling the naked put on top of that wouldn't. But if I'm wrong and it reverts back, the other three ways we just talked about, rolling the bear call itself up without moving the bull put, rolling the short leg up one, or even moving the whole spread, as Mark mentioned, would have likely worked better than trying to just sell the put above the calls or vice versa. Because when you're in a whipsaw, you're going to take that 10-point loss, that 10 times loss potentially. All right, in that situation, okay. Yeah, and it's the Sam said the mention is look at the nature is to push it up. The nature has been to push the market up in this case. Selling a put is not a bad idea, but not necessarily the way to repair an Iron Condor. You just don't want to be in that situation. You don't want to be in the neutral to bullish position. I'm sorry, you don't want to be in the neutral position if everything is going back to being bullish there as well. Okay, and he says if it goes moved outside of the range. And another thing on that comment, Rhajiv, I wanted to mention here. When you said it moves outside of that position, we go outside of that position. It goes outside of the range. I don't know what you mean by range. I would never let, if possible, an Iron Condor go too far into this realm or to here. I'm going to manage the bear call side if the stock reaches maybe within 1 to 0.5% of my short call strike price, or the same range here to my short put strike price. I'm not going to let the spread go against me here or here and then worry about management. I've got better opportunities to do the management techniques I talked about before my short options go in the money. Okay, now that being said, as long as I'm avoiding earnings, you don't usually see some kind of overnight 7, 10, 15% up or down direction. Remember, that can happen at a time when you're trading a neutral strategy such as an Iron Butterfly, an Iron Condor, calendar, horizontal calendar spread, same strike spread, for example. Once that move happens, you're not going to be able to really manage the position. I mean, you could try to manage it. So let's say SPY, I'm in this, and SPY gaps up on Tuesday at the market open to 305. I'm going to take this loss. I'm not going to try to manage it. I might do another bull put spread, depending on the reason why SPY has jumped up to 305 on Tuesday. That's all I'm saying. I'm not going to say, oh, well, let me add a short put here and do a double back spread ratio here if I can get this to a small profit. No, I'm going to take my loss. And you know what? Remember, when you're in a trading plan, meaning that you know what your reasonable expectations are. And let's say for a bull put credit spread, I expect to be right 82, 83% of the time. I'm looking for a gain average of around 7%, and I'm looking to control my losses on the margin requirement that I put in to under maybe 45% or 40 so. As long as I keep this, I will hit my target goals. That's what I used the trade simulator for that I ran earlier to compare the in-the-money naked puts to the out-of-the-money naked puts that we did. Okay, so if that's my kind of structure for an Iron Condor, guess what? When I entered this trade, I was okay taking the potential loss, even the full loss of this position, because I've been managing the others to the reasonable risk-reward loss, okay? And so I'm okay occasionally taking one or two of these from an unexpected event, because I know long-term, I'm matching my trading plan, all right? When I start to do too many adjustments and now I start to lower my expected gain to 3% because I'm cutting down from the maximum, but you say, oh, but now I'm only taking 15% losses instead of the 45 on average, but now I'm also taking some 7 or 8% losses too, so I'm actually lowering this down to 79. this might not match my trading plan. Okay, that's the trick. Sometimes these managements can take you out of your trading plan. They can take you out of what you had originally put in for your expected target, expected loss, and probability range. And if that's the case, you've got to reevaluate if it's going to work. And you can't control, Rhajiv, you're right, we can't control that huge moment after hours, okay? Sam commented, he traded SPY all this week. He had more puts than calls, and they were all profitable. And last week he had more calls than puts, and they were all profitable. Yeah, the market changed drastically, caught me off guard. I should have told everyone on Friday. What should I told you? I did one right thing, I did one bad thing. Last week, GOOS, I'm sorry, Canada GOOS, GOOS, one of the married puts I'm in. It had been wavering at about $54, $53, $52. No, it was about $54, $55, $53. Where is she? There she is. And let's take a look here. All right. So you see here, after that huge jump from earnings, it dropped down below 50. It's just been holding, it's holding, it's holding. Stock came up here. I said, you know what? I'm going to take a chance. Not really take a chance. I wanted to generate some premium. So right when the stock was around 54, I said, you know what? We haven't been up here in a while. Crossover was close, but we weren't above the 20-day yet. So I said, let's sell the 57.5 call for $1.60. It was good premium. So now it's at 60. And now I got to pay $3.15 to buy it back, and expires on Friday. So I got to figure out what to do with it. I'm hoping there's a little pullback here. But yeah, I should have told everyone. I sold the call Friday morning, right before Friday morning before last week's webinar. So I sold a call on GOOS. That meant the market was going to go up. Should have been selling puts and buying calls this week. Same thing with OLLI, but that worked out better. I rolled the put up, and a customer even asked me today. I rolled from the 75 to the 80, as I mentioned. When the stock went up to 82, I let it go up to 82 on OLLI. And that's when I rolled up the put to 80 because it gave me a better premium. Now it's at 87. Someone asked me, are you going to roll to the 90? Or are you going to roll to the 85? I don't know. I don't know if I'm going to put more cost base into that. I have a 0.6, 0.7% maximum loss in this trade with earnings coming up next week on the 6th. If it gaps up, I might as well leave my cost basis where it is. If it gaps down, this puts out to January. I can manage the position very easily. So I'm not going to sell a call. I thought about that too. Sam says, you know, should have done a bull put with the call. Absolutely. Yeah, should have done a bull put with the call. Absolutely. Should have done the bear call credit spread, income method number 6 of the radioactive trades. That would have looked better now too, but not too much because I would have done the 57.5, 60. Still would have gotten a good premium, but the 60 wouldn't be paying off just yet because it's right at 60. So, all right. But yeah, just with the OLLI one, let's take a look. I could roll to either one right now. I could roll to the 85 or the 90, but let's see if this works. Even though the stock's at 87, my put still is retaining value, right? So it's about 360 would be midpoint. If I roll to the 90, that's also, wow, $1.20 bid-ask spread. I'm not getting midpoint on that one. But let's say that we do sell this for midpoint at 360. Oops. Market maker is going to force me to go way closer to this. So instead of the 60 cents at 8.10, I'm probably going to be paying about 8.40, I think, for that. Just looking at it. So 360 to 8.40. That's not good. Oh no, it's a 10-point. Whoa, yeah, that is good. I'm sorry. So I'm looking at 480. Yeah, $4.80 to gain 10 points. That's a decent payment. That's under 50%. Bulletproofs to 5.6% ahead of earnings. How can I not do that? Well, now my cost basis is up to 85.25 in the trade. Okay, as opposed to having an underlying cost basis $500 less at 80.45. So that's the trade-off. And I'm pretty close to bulletproof, but I could guarantee a 5.6% profit and leave the upside open. It's very tempting to do. Very, very tempting. Naturally, though, I have to wait till Tuesday, so lack of a better term, I'm saved by the bell. Speaking of saved by the bell, I don't see any other questions that have come in. There were several other comments from Sam that I kind of went over, but I might have missed one or two there. but it is 10 after 6 p.m. Eastern Time, and I don't see any other questions. So at this point, of course, I think it's a good time to just let everyone know here that there we go. Of course, that I just want to remind everyone that today's material is my thoughts on your questions, designed for educational purposes, increasing investing performance, and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. We ran multiple evaluations of what a trade would look like if you managed it or adjusted it. Talked about the inversion there and rolling that position, comparing the in-the-money naked put to the out-of-the-money naked put. Those are all for examples so you could see the risk-reward profile, see what you'd get as far as potentially a trading plan would go. Not a direct trading suggestion on any of the stocks that were talked about today. Options do involve risk, may not be suitable for all investors. Reminder, Mike Chupka never updates his slides except for the first one when he does these presentations, but reminder, the markets will be closed on Monday, September 3rd, in honor of Labor Day, and we'll only have a 4-day weekend next weekend, okay? Or 4-day trading week next week. That's what I wanted to say. If you haven't done so yet, if you'd like some of the tools you saw today, we looked at the portfolio tools a little bit. We ran some of the custom spread tools. I showed you how to access some of the historical chain. For those who are subscribed to the historical service, $100 per month, the 20-minute delayed plus the historical. You can also add it to the real-time service. That goes back to April 2006, over 10 years of trading data, options, and the stocks as well. But you can take a 14-day free trial with no credit card needed, no risk to you whatsoever, to Power Options to test out all of those tools and more. Just need first name, last name, and email address, and you will have 2 months of historical data to play around with, which we looked at a little bit today. Just go to powerop.com, put in your name and email, and click Start My Trial Now. We'll send you a password. Afterwards, subscriptions do start at $40 per month. Talked about the delayed service and, of course, the historical service. We do offer a real-time service as well. If you want some other educational materials during your long 3-day weekend, remember you can go to the blog at any time, blog.powerop.com. We do archive most of our presentations. You can access them at any time. Just go to powerop.com/webinars.asp. Our Friday sessions are recorded under the requested topics category, but you also see topics and categories for Power Options tools, options strategies, and options concepts. You can always check us out on YouTube as well. Khokon had mentioned, Mike, you're going to have a chance to post this webinar earlier this weekend. I believe I will be, but I'm not going to tease you and tell you when. But you'll have it before Tuesday. I'll promise you that. You'll probably have it before Monday. I'll promise you that. You'll have it before Sunday. I can state that and mean it, but I'm not 100% sure. But you'll definitely have the webinar available before Tuesday, Khokon. That I do promise. Before Monday, I do promise, and probably before Sunday, meaning sometime tomorrow you should expect to see it. Ladies and gentlemen, thank you for joining me. Have a great extended weekend. Have a happy trading week next week. You'll see some more information coming out from us next week as well, some other educational materials. I look forward to seeing you all potentially next Friday for another open discussion session. Good night, everyone. Happy trading.